462.
All right. And big volumes on Reliance as well, Mitesh. Thanks very much. IGL and Reliance, two ideas coming in from Mitesh at this point in time. Let's welcome in veteran Nilesh Shah, is Managing Director, Kotak Mahindra Asset Management Company. He's joining us right now on the program on a day when the market and the Nifty has made a new high. The Sensex did so last week. The Bank Nifty, of course, has been making new highs in any case. Nilesh, hi, good afternoon. Great to have you with us here today. Your thoughts, Nilesh? I mean, now that we are at a high, what next, right? I mean, you're in that sense, uncharted waters. With a lot of uncertainty around the globe still very much there, how would you look at things?
So, Prashant, if we look at the last 12 months, it has witnessed a couple of very, very important features. One, this recovery is despite heavy selling by FPIs between October 21 and June 22. Clearly, domestic, institutional and retail investors have come of age. We are in a position to withstand foreign portfolio investors selling in case that arises. The second thing is also linked to domestic economy. Clearly, between last high and this time, domestic sectors have taken the lead: banking, manufacturing, industrial, whereas global sectors like IT, pharma, and metals have not delivered performance. So undoubtedly, as long as domestic investors' confidence stay on long-term India growth story, and our economy continues to differentiate itself vis-a-vis global peers, I think the journey of market will continue forward. Does that mean that tomorrow also we will have an all-time high? Answer is obviously no. Markets are markets. They'll go up and down. But as long as investor confidence and economic performance continue to come, we'll continue to move forward.
Nilesh, afternoon. Sectoral rotation is very common in the market. 2021 belonged to the IT sector. 2022 belongs to banks and the PSUs. What will 2023 belong to the next 1 year? Where do you think leadership will come?
So if we look at calendar year 23, we believe some of the beaten down sectors like IT and pharma could provide an opportunity. But for IT, the catalyst will be NASDAQ bottoming out and recovery. For pharma, the catalyst will be earnings stroke revenue growth. But subject to that kind of bottoming out of sectors which have been underperforming markets for calendar year 22, the sustenance story should continue in banking and domestic economy related sector. Banks no doubt have delivered great performance in 22. We do expect that to continue even in 23 with NPS coming to historically low levels and rising interest rates supporting the profit margins. On domestic sectors, we believe industrial, capital goods and engineering should do well, as not only the government demand but also private and export demand will support better volume growth. So overall continuity of performance in banking and domestic sectors like engineering, capital goods, and some entry point over next 6 to 8 months in IT and pharma.
And you will be ready for that when that happens. That's the point. Nilesh, we had Pankaj Tibrewal with us earlier in the program in the morning today, and he was kind of highlighting a little bit of stress which seems to be starting to emerge on operating cash flows. He rattled off lots of statistics, but that one was what he said made him worry a little bit because liquidity in the system is also tightening somewhat. Any thoughts, Nilesh, on this? Because this is happening after quite some time now.
Absolutely. Pankaj made a very, very important point which our researchers are working on. At Kotak Mutual Fund, we observed that in the September 22 quarterly result, the operating cash flows have taken a nosedive. Working capital has increased tremendously. Inflation has also resulted into increases in working capital. And somewhere the rotation of cash from business to business has also seemed to slow down. Clearly, is this a trend which is likely to continue, or is this an aberration? We'll be carefully observing December 22 quarterly results to confirm whether it was an aberration or is it a trend. And in our portfolios, we are putting far more focus on companies which are able to maintain operating cash flow rather than just the profitability. History has taught us that cash flow is the sanity, everything else is vanity.
Very well put, Nilesh. So, I also sort of pressed Pankaj on that point. He said, well, the sectors which are seeing this are metals, chemicals, and cement. But these are sectors which anyway were expected to do pretty poorly, right, in Q2, Nilesh? Or is this a more generalized trend that you're seeing? And what is your own hunch? Is this like a one-off, as you said, or, this could continue?
So our feeling is that to a great extent, September 22 quarter witnessed dramatic drawdown of domestic liquidity, the FX intervention, the festival season demand, which generally increases currency in circulation, and the CRR hike, which continues to, CRR ratios, which continue to take away some liquidity. All those things put together resulted into outflow of domestic liquidity, and that probably is reflected into cash flow of operating cash flow of companies. As I mentioned, we have to wait and watch for December 22 quarter. In my opinion, it might be an aberration and not a long-lasting trend. The circulation of money should start improving as FX reserves have started going up. FX outflows, which were taking domestic liquidity out, will be converted into FX inflows, adding to domestic liquidity. So hopefully operating cash flow should start improving in December 22 quarterly results.
Okay, so the shrinkage in operating cash flow is perhaps an aberration, but we will wait to see what Q3 earnings show up. But Nilesh, if it's not, what is the signaling from this contraction that we've seen in operating cash flow in these particular sectors? And if in Q3 as well, the picture is fairly bleak on this cash flow front, does that mean that people should remove these stocks and sectors from their portfolio?
So undoubtedly, today Indian markets are trading at a marginal premium to its long-term average and a substantial premium to its emerging market peers. In order to justify those valuations, one has to deliver better performance. In some sense, Indian market is like Surya Kumar Yadav. No matter what the pitch is, no matter what the bowling is, you have to deliver because there is expectations from number one T20 batsman in the world. If operating cash flows are not reaching to investors' expectation, then there is potential of derating in the valuation. And we'll have to keenly observe in which sectors, which companies stress on operating cash flow is becoming, endemic or long-lasting, vis-a-vis where it is a temporary aberration. I think next year's return will come from those investors who are able to bet upon companies whose operating cash flow is not disturbed or reduced despite current situation.
All right, Nilesh, appreciate you sharing those thoughts with us. Very useful, very interesting. Thank you so much for joining us here on the program on CNBC-TV18. As you said, cash flows are sanity, everything else is vanity. Well put. Nilesh Shah of Kotak Mahindra Asset Management Company there. 82 points on the Nifty. We're at 18,594. So just under the highs by about, 15, 20 points or so. We'll take a break, the first on the program here. On the other side, my colleague Nigel is standing by at the Bombay Stock Exchange with Deepan Mehta. And we'll get you the conversation, the buzz from the BSE on the other side of this short break.